Silver didn't just lose $8. It revealed something far bigger cracking beneath the surface. When a metal moves nearly 10% in under 2 hours, that's not weakness. That's stress inside the system looking for an exit. We watched, in horror, as silver plunged from $83.08 to $75.11 per ounce, erasing nearly $8 or 9.6% in under 90 minutes, while the S&P 500 fell 2.1% and the Nasdaq Composite dropped 3.0% during the same window. The US dollar index strengthened from 101.37 to 102.72 plus 1.3%, and the 10-year Treasury yield climbed from 4.05% to 4.19%, tightening financial conditions in real time. COMEX March silver open interest stood near 448 million ounces, while registered deliverable supply hovered around 103 million ounces, meaning less than 23% of paper claims were backed by warrant-ready metal at first notice proximity. Volatility surged as the VIX moved from 18.4 to 24.6, plus 33.7%, triggering systematic risk reduction across leveraged portfolios. These figures point not to collapsing demand, but to mechanical deleveraging under macro stress. What unfolded was not a verdict on silver's utility. It was a cascade inside a leveraged ecosystem. When yields rise abruptly and equity volatility expands by more than 30% in 24 hours, multi-asset funds recalibrate risk models. Commodity allocations, especially those with embedded leverage ratios exceeding 10-to-1 in certain future structures, are reduced first because they are liquid and margin sensitive. Silver's decline, therefore, reflects its position within the capital structure of risk, not a deterioration in its fundamental value. Historically, forced liquidations create short-term distortions that later reverse. During the 2020 liquidity shock, silver initially fell nearly 35% in 1 month, only to rally more than 140% over the following 5 months as monetary expansion took hold. The present episode shows similar mechanics. Margin adjustments amplify selling pressure, yet they do not alter structural supply-demand imbalances. Global mine production is projected around 850 to 880 million ounces annually, while total demand in recent years has exceeded 1 billion ounces, creating persistent deficits. That imbalance does not disappear because futures traders reduce exposure for 48 hours. The second dimension, exposed by this drop, is the divergence between digital contracts and tangible metal. Futures volumes can exceed 200,000 contracts in a session, representing hundreds of millions of ounces traded on screens. Yet only a small fraction, often under 5% of contracts, results in physical delivery. When price falls sharply, but retail premiums remain firm or widen by 20 cents to 50 cents per ounce, it signals that physical supply chains are not experiencing panic liquidation. The dislocation is financial, not industrial. Moreover, macro conditions increasingly favor higher precious metal valuations. Inflation expectations in major economies remain above 2%, while policy rates, though elevated, are constraining growth metrics that have slowed to near 2% real GDP expansion. Historically, when real yields compress by even 50 basis points, silver has responded with outsized percentage gains relative to gold. Should the Federal Reserve pivot even modestly, a move in silver from the mid-$70s to triple digits would represent less than a 35% increase, well within historical volatility norms for the metal. The broader vulnerability lies in leverage embedded across asset classes. U.S. federal debt now exceeds $34 trillion, and annual interest expenses have crossed $1 trillion, increasing systemic sensitivity to yield fluctuations. If bond volatility persists above 20 on major indices, cross-asset liquidation pressures will reappear intermittently. Each episode weakens confidence in purely financial claims and strengthens the appeal of hard assets. In previous tightening cycles, where debt burdens were lower by nearly 40% relative to GDP, silver still managed multi-year advances exceeding 100%. Industrial fundamentals add another layer of support. Solar panel production has grown at double-digit annual rates, consuming over 100 million ounces per year, and electronics demand continues expanding alongside electrification initiatives. Even conservative projections imply deficits of 100 to 150 million ounces annually, which gradually erode above-ground inventories. When investment flows re-enter a structurally undersupplied market, price elasticity can be dramatic. Therefore, the recent $8 collapse should be interpreted as exposure of systemic fragility rather than weakness in the metal itself. As deleveraging subsides and macro liquidity stabilizes, capital will likely rotate back toward assets insulated from counterparty risk. Given persistent supply deficits, elevated sovereign debt, and the historical tendency of silver to overshoot during monetary transitions, a climb toward $150 per ounce over the coming months is not speculative fantasy, but a scenario consistent with past volatility cycles. The drop did not negate silver's trajectory. It illuminated the stresses that ultimately propel it higher.